Imagine buying a home in what seems like a peaceful, growing British town, only to watch its value collapse within months. Across the UK, there are regions that look perfectly safe on the surface: quiet suburbs, shiny new developments, even booming commuter towns. But beneath that charm lies an economic time bomb. Rising interest rates, crumbling local industries, overinflated house prices, and government policy shifts are quietly setting the stage for one of the biggest property downturns in decades. In this video, we're exposing 10 UK regions that appear stable but could become financial nightmares by 2026. From flooded coastal towns and overpriced commuter belts to cities dependent on unstable job markets, these places are far riskier than they look. If you're planning to buy property next year, you'll want to hear this list before signing anything. Let's begin. Cornwall's rolling coastline, charming fishing ports, and sun-drenched beaches have long made it one of England's most desired places to live. But behind the postcard appeal, a quieter reality is emerging, one that signals trouble ahead for buyers in 2026. While house prices have remained elevated, for example, an average home price of around £292,000 in March 2025, and affordability ratios in the area span over 10 times local full-time earnings, the market is showing signs of strain. On one side, tourism and second home ownership have pushed demand and arguably inflated prices. On the flip side, as mortgage rates remain high and the cost of living rises, many local buyers are being squeezed out. Listings are increasing. The supply of homes for sale in Cornwall was reported as rising 13% year-on-year in one local update. This uptick in supply, combined with weaker newcomer demand post-pandemic, means buyer power is shifting. In March 2025, the rental market slowed sharply, with annual rent growth in Cornwall falling to just 3%, the weakest rate in over 3 years. Add to this the fact that many homes in Cornwall are reliant on holiday-let income or part-time occupancy, making them more vulnerable to changes in regulation, tax, or fleeting tourism trends. Some towns already report falling prices. For example, in Perranporth, one study cited a drop of about £13,000. Put it all together, and Cornwall appears increasingly risky. High prices, stretched affordability, rising supply, and reliance on fickle tourism. What once looked like a safe coastal investment may, in fact, harbor latent downside risk. For 2026 buyers, Cornwall may no longer feel like a sure thing. The dream is starting to crack. Built for London workers seeking more space and lower cost, Essex is now showing warning signs that suggest its property market may be heading for a correction. Average property prices in Essex hovered around £404,000, with some slowdown in transaction volumes. Sales down roughly 7% in the year to August 2025. At the same time, supply is rising. Homes for sale in Essex, Norfolk, and Suffolk had listings up 13% year-on-year in some reports. Morgan & Associates. What's changed? Remote working has altered the commuter town calculus. For many buyers, the daily train into London is no longer essential. That reduces the premium that Essex used to command. Moreover, new build volumes in the region have surged, pushing up supply faster than lifestyle changes have occurred. Local taxes, infrastructure demands, and increasing living costs in suburban zones are also exerting pressure on households. Although some reports still describe the region as resilient, the combination of rising supply, demand shifts, and affordability constraints points to vulnerability. For example, the time on market in Essex has been prolonged in recent months. Buyers entering Essex now may be taking on more risk than they realize. Higher-priced homes, weaker commuter premium, and a building-led supply surge. Given these dynamics, Essex may turn out to be one of the regions with the greatest downside by 2026. What looks safe could easily turn into a mid-market trap. Kent, dubbed the Garden of England, retains immense charm. Historic towns, fast links to London, and attractive countryside. However, these very features are now creating hidden risk lines for buyers looking ahead to 2026. A key factor is oversupply. Large development projects in towns such as Ashford and Maidstone have pushed up new home volumes significantly, which can depress resale values when the market cools. Flood risk too is rising in parts of Kent's low-lying areas, and insurers have begun raising premiums or withdrawing cover in certain flood zones. These environmental headwinds are increasingly factored into home buying decisions. Wages in many Kent towns have not kept pace with the steep house price growth of recent years, meaning affordability ratios are stretched. While public data for Kent's exact ratio is variable, the national context supports the concern that commuter belt premiums aren't guaranteed anymore, especially as mortgage rates climb. When upsides shrink, downside risk grows. Buyers may assume that good transport links to London will keep values safe, but that assumption overlooks structural shifts. If London employment weakens or commuting becomes less essential, that premium may evaporate. To make matters worse, new environmental levies, for example linked to flood mitigation or energy efficiency, are adding cost burdens to homeowners who already carry heavy mortgages. In short, Kent's mix of location premium, heavy new build volumes, and heightened environmental risk suggests that what looks like a secure bet might be a latent trap. For those buying now planning to hold through 2026, the potential for a significant correction is real. Once hailed as the next big property hotspot in the UK, with ambitious regeneration plans, rising city centre living, and an influx of young professionals, Birmingham now finds itself in a precarious position. In September 2023, the Birmingham City Council issued a Section 114 notice, signalling that the authority could not meet its financial commitments due to an estimated back pay equal pay bill of around £650 million to £760 million and other liabilities. This fiscal collapse has profound implications for the local economy, infrastructure, and by extension, the housing market. Cuts to public services, rising council tax, and investment uncertainty are now becoming everyday realities for residents and potential buyers. From a property perspective, the narrative of city boom may be losing its power. Investors who once flocked to Birmingham for high-yield opportunities are increasingly cautious. When rental yields begin to fall, vacancy risk rises, and market exuberance fades, it opens the door for correction. Although precise published figures for residential vacancy remain limited, the backdrop of general service cuts and economic gloom erodes the confidence that underpins housing demand. Moreover, the regeneration projects that were meant to underpin long-term growth are now at risk of delay or cancellation due to funding constraints. Infrastructure upgrades, new transport links, and major mixed-use developments often act as catalysts for value uplift. When those catalysts falter, the risk to house prices increases. The combination of high-priced new development, uncertain job market prospects, and public service contraction means that what appeared to be the rising northern powerhouse might transform into a more brittle settlement. For buyers entering Birmingham with 2026 in mind, the outward appeal, modern apartments, city centre buzz, regeneration glow may mask deeper structural issues. A financially troubled local authority, weakening public services, and possible correction in investor demand all point towards significant downside risk. The city may yet recover, but the margin for error has narrowed, and the consequences of a misstep could be amplified. What looked like a safe, vibrant urban bet may prove to be one of the steeper climbs on the path ahead. At a glance, Manchester continues to project strength. A growing skyline, high-profile corporate relocations, and robust interest from domestic and international property investors. The average house price in the city was recorded at around £249,000 in August 2025, up only 1.2% from the previous year, signaling a marked slowdown in what was once strong growth. But beneath the facade of upward momentum, deeper concerns are emerging. Developers have flooded the city centre with high-rise apartments, many tailored to overseas investors or short-term stays, rather than long-term residents. This oversupply is becoming visible. Vacancy rates in offices and echoed in residential markets are increasing in certain sectors. While earlier forecasts predicted significant growth for Manchester, including projections of nearly 19.3% appreciation between 2024 and 2028 for some schemes, markets seldom move in straight lines. The danger lies in the distance between expectation and real occupancy or usage. Luxury flats that rely on international buyers may face a stall if investment sentiment shifts or global capital flows slow. If units remain unoccupied or leased at lower rates, downward pressure on values will follow. Another vulnerability lies in affordability and yield. With high purchase prices relative to local incomes and rental growth stagnating. For example, rents rose approximately 4.8% in September 2025, compared to 7.1% in the Northwest overall. The margin for investor error is thin. Where yields compress, financing becomes harder, and exit risk increases. For those buying now with the expectation of continuing strong growth, the signs hint that Manchester may be shifting from a high-growth phase into one of consolidation or correction. The mismatch between supply and demand, the lagging rental growth, and the heavier reliance on overseas or investor buyers all point to a sharper downside than many anticipate. In other words, the skyline is still rising, but the foundations may be less robust than they appear. 2026 could be the point where the gap between optimistic forecasts and economic reality becomes evident. Whilst Sheffield has often been praised for its post-industrial resurgence and value appeal, a closer look reveals structural vulnerabilities that may undermine its stability heading into 2026. One key issue is the quality and energy efficiency of much of its existing housing stock. The local authority's Housing Growth Delivery Plan 2025 to 2030 notes that the median energy efficiency rating of existing homes sits at around an EPC-D level, and significant investment will be required to improve it. New regulatory burdens are looming. Landlords and homeowners face rising expectations around minimum energy standards, and the cost of upgrades is becoming a heavy overhang. Nationally, some research indicates that large portions of landlord portfolios fall short of required standards, increasing the possibility of forced sales, higher maintenance costs, and weaker resale values. Beyond energy issues, job growth in Sheffield remains relatively stagnant, particularly in the private sector, knowledge economy roles that typically support urban housing markets. Whilst local regeneration schemes exist, the shift from heavy industry to service and knowledge roles takes time, and the housing market may be that much more exposed if employment growth underdelivers. Also, with fewer students and younger professionals entering the city centre, the demographic tailwinds that support rental demand may weaken. Given this backdrop, Sheffield's housing market faces a subtle but consequential set of headwinds: higher compliance and upgrade cost burdens, moderate job growth, and a housing stock that may require expensive upgrades. Just as many homeowners and landlords face tighter affordability and financing. For buyers envisioning stable value through to 2026, these headwinds may erode the margin of safety. What once looked like a low-price entry into a rising city may instead become a liability as regulatory and economic pressures converge. Cardiff may look like a stable and safe bet on paper, a national capital with a mix of public sector jobs, universities, and a growing cultural and waterfront scene. Yet for buyers thinking ahead to 2026, the surface calm conceals genuine vulnerabilities. Average property prices in the city reached around £273,000 in March 2025, up about 5.6% year-on-year, which signals modest growth rather than a booming surge. One underlying risk is the weight of the public sector in Cardiff's employment base. When a region's housing demand is heavily reliant on government jobs, cuts or austerity can cause sudden shifts in demand. In Wales, budget pressures and inflation-eroded wages mean many households face tighter budgets, reducing both the pool of buyers and the ability to sustain rent or mortgage payments. Waterfront apartment schemes built during the boom years face particular exposure. Some developments show signs of value stretching, as higher prices and maintenance costs meet a less secure economic backdrop. These units often rely on investor or buy-to-let demand, a segment sensitive to regulatory change and financing conditions. Furthermore, although recent data shows average prices rising modestly, the upward momentum appears fragile. The Principality Building Society, Wales House Price Index in the first quarter of 2025 found annual growth of only approximately 4% for the region. Time on market is relatively short and sale volumes have slipped. For example, approximately 11,000 transactions in the year to mid-2025, suggesting that the balance of supply and demand may be shifting. For a buyer looking at a 2026 horizon, these factors mean that Cardiff may not offer the upside many assume. Instead, it carries overhang risk. With modest price growth and exposed structural employment dependencies, the chance of stagnation or mild decline is real. The city may look stable, but in a tougher economic climate, it could quietly underperform compared to other regions. Edinburgh has long enjoyed a reputation as one of the UK's bulletproof housing markets. Historic charm, a strong tourism economy, and high academic and professional credentials. However, beneath that veneer lies a growing set of headwinds, making it a region to watch with caution when buying for 2026. One of the foremost issues is regulation of the short-term let market. Edinburgh was one of the first Scottish cities to introduce strict licensing rules for short-term lets, properties that had previously benefited from visitor demand and investor-driven income. With more landlords forced into long-let markets and less able to rely on holiday-let premiums, some previously high-yield properties may see their value challenged. Another concern is rental market dynamics and affordability. In summer 2025, the CityLets report for Edinburgh indicated that while tenant demand remained strong in certain segments, for example one-bed furnished apartments, the broader rental market had become flatter than in the boom years. Oversupply of high-end flats, particularly those developed with investor or overseas buyer focus, adds to the risk. If occupancy and rents slip, price correction becomes more likely. Finally, living costs and migration trends matter. As households face inflation-driven cost pressures, the premium of city centre living comes under question. Some buyers are already shifting attention to more affordable Scottish towns. The combination of regulatory retrenchment, evolving rental dynamics, and high price baselines means Edinburgh, though still strong, may be vulnerable to a plateau or modest correction by 2026. Norfolk might appear as a safe, affordable region for property buying, attractive coastal scenery, lower price points. Compared to major cities, Norfolk has a strong appeal for retirees and second home buyers, yet lurking beneath the charm are environmental, infrastructural, and market issues that could make it a risky purchase for 2026. Coastal erosion, flood risk, and rising insurance premiums increasingly impact parts of the Norfolk coastline. Towns such as Great Yarmouth and Hunstanton are among areas where these pressures are mounting. While exact numbers vary, insurers are reportedly withdrawing cover or raising premiums in flood-prone zones, thereby raising holding costs and reducing resale prospects. Furthermore, infrastructure investment in more remote or coastal areas often lags compared to metropolitan zones. When maintenance, transport links, and services become less reliable, the attractiveness of the location can deteriorate over time. If one buys in a location where long-term servicing and connectivity are uncertain, the currency of that property diminishes. Add to this a shift in buyer demand. If rising mortgage rates, interest rate uncertainty, and tightening lending make second home purchases less attractive, then regions heavily reliant on such buyers will feel the impact. In Norfolk, where a portion of demand is seasonal or investment-driven, this vulnerability is significant. For investors or owner-occupiers looking at a 5-year horizon to 2026, Norfolk's combination of environmental risk, service uncertainty, and demand fragility means what looked like a safe value play could morph into a liability. Leeds was once hailed as one of the UK's northern growth engines, a city of rising office space, tech startups, city centre apartments, and ambitious regeneration. But as we move towards 2026, several cracks in that narrative suggest caution for property buyers. First, overdevelopment is a genuine concern. The city centre has witnessed a flood of new flats and build-to-rent schemes, many targeting investors. Capital rather than underlying resident demand. If absorption fails to keep pace, vacancy risk and downward pressure on prices and rents can emerge. Second, data show that mortgage arrears in West Yorkshire, which includes Leeds, have been climbing at rates above many other major UK cities, a sign of affordability pressure, income stress, and potential default risk. Third, the tech sector growth, which was once expected to underpin Leeds' future, has slowed. When employment growth stalls, housing demand excess often shows up later. Crime rates rising in the city centre, combined with reports of decline in certain neighbourhoods, can also chill buyer confidence in what once felt like a safe city investment. With these structural pressures, the margin of safety for Leeds as a housing investment has narrowed. Buyers assuming continuous upside may find themselves exposed to correction rather than growth. If oversupply, affordability issues, and employment sluggishness converge over the next 12 to 24 months, Leeds could experience a meaningful downturn, one that catches many by surprise. Before you buy, remember, markets don't crash overnight. They crack first, and those cracks are already showing. We built a full breakdown revealing where the next property collapse starts, so hit subscribe now before it's too late to react. And tell me in the comments, which UK city do you think will fall first? London, Manchester, or somewhere no one expects?